In this video, I'm going to show you how you can see the same opportunity given by an ICT entry model using other tools of technical analysis that have been around for a long time. Keep in mind that these techniques are not mutually exclusive. You can combine them and achieve good results. The reason I made the last video called Learn ICT Concepts in 30 Minutes is for this precise reason. You can see many of the same trade opportunities using other tools in technical analysis, some of which ICT followers claim to be ineffective or tools used by the retail traders only. If you are an avid follower of ICT, please keep an open mind about this, as I'm not trying to disprove anyone's method. I'm just trying to provide a different perspective that I see a lot of people missing. The point I'm trying to make here is that it's not wise to throw decades of solid technical analysis out of the window. Smart money is just one valid approach in technical analysis, and as it is taught in all serious technical analysis certification programs of the world, the master principle in technical trading is integration, which is to combine multiple trading approaches in order to increase the chances of success in a trade. So in this video, I'm going to show what's called the unicorn entry model in ICT's method, and then after, I'm going to show you how you can see and trade the same thing using other perspectives of technical analysis that have been around since the 20th century and that I have been teaching in my fractal flow methods for a few years now. I am not claiming that ICT stole these ideas. I'm just saying that you can arrive at the same conclusions through various different perspectives, and that will lead me to other conclusions at the end of the video. So make sure you watch everything before you comment. ICT entry models will point to good trades, but there are lots of other high-quality trades that will be missed if you only focus on ICT. On the other hand, by using integration, you can maximize the number of high-quality trade opportunities you find in the market, including the ones you can see with ICT's method. In summary, ICT trades can be of high quality, but not all high-quality trades can be seen through ICT. Only integration provides the necessary framework for high-quality trade opportunities to be exploited with high frequency. With that said, let's move on to the understanding of the unicorn entry model in ICT's method. The unicorn entry model in the ICT method is the combination of two concepts, the breaker block and the fair value gap. To understand breaker blocks, we first need to identify a price movement or market structure where a higher high is followed by a lower low, or when a lower low is followed by a higher high. ICT followers sometimes call this a market structure shift, but this formation has been called many different types of names throughout the history of technical analysis. For example, an expanded pivot formation, a broadening formation, and if I'm not mistaken, Wells Wilder called this pattern a non-failure swing in one of his books published in 1978 called New Concepts in Technical Trading Systems. So market structure shift is just another name to describe this expanding pattern. The breaker block is identified by a specific candlestick in one of these price movements. In a bearish breaker block, we'll observe a higher high followed by a lower low. The breaker block itself is the last bearish candle before price creates the higher high. The theory here is that price will retrace back to this area before making a significant movement to the downside. In the case of a bullish breaker block, we'll observe a lower low followed by a higher high first. The second step is to identify the last bullish candle before price made a lower low. The theory here suggests that price will retrace back to this area before making a movement to the upside. That's half of what you need to use the unicorn entry model. The other half is the fair value gap, which I already explained in my previous video, but I'll make a quick review right now. The fair value gap is a 3-candle pattern that hides a gap between the shadows of the first and third candles. In a bullish fair value gap, there is no overlap between the upper shadow of the first candle and the lower shadow of the third candle. In the bearish fair value gap, there is no overlap between the lower shadow of the first candle and the upper shadow of the third candle. As I said before, the unicorn entry model consists in the intersection of a breaker block with a fair value gap. In this illustration, you can see the hypothetical example of a bearish unicorn entry where price reverses at the intersection of the breaker block and the fair value gap found in the price movement that creates the expanding formation. In this other illustration, you can see the hypothetical example of a bullish unicorn entry, where price reverses at the intersection of the breaker block and a fair value gap found in the price movement that creates the expanding formation. Notice that even within ICT's method, there is the idea of trading the intersection of techniques, which is formally called integration. Let's now move on to a real price chart and observe the unicorn entry model in action, and right after, I will show you other ways of seeing the same opportunity using traditional tools of technical analysis. Here we have a 1-minute chart of the Brazilian index futures market. The first thing we need to pay attention to when looking for a unicorn entry model is the expanding pivot formation, or the market structure shift, as the ICT followers call it. And here we have a very clear example of that. In this chart, you can see how price forms a higher high, and then right after, it forms a lower low. The next step would be to identify the breaker block and the fair value gap. In this case, we are dealing with a bearish formation, so the breaker block is the last bearish candle before price made the higher high, which is highlighted right here. We also need to identify the fair value gap in the subsequent price movement that overlaps with the breaker block, which is highlighted right here. Moving a few candles into the future, we can see how price does retrace to the intersection between the breaker block and the fair value gap, giving the trader several opportunities to trigger a short trade. Let's assume the trader chooses to enter at the upper limit of the fair value gap, placing a stop above the highest high in the chart and a target at this low, as it is common in the ICT method from what I have seen. This trade holds the potential for a 2.23 risk-reward ratio. Let's see how the market develops after this. In this next chart, we can see that the market indeed hits the target, but it misses a lot of the movement down. This is one example where the unicorn entry model worked, although we can argue that the risk management part is not so great. Let's now roll back the chart and start with a blank canvas, so I can show you a completely different perspective on how you can trade a situation like this. For the followers of my methods, especially the techniques found in the Price Action Trading Volume 1, the moment you look at this, we can already pinpoint the expanding pivot formation, which logic demonstrates that sellers overcame buyers due to the lower low occurring after the higher high. The other obvious thing for fractal flow students here is the inward frequency line, as you can see here. The inward frequency line is usually a sign of reversal, and it can also be used as support and resistance, among other things. It's based on the idea of combining traditional support and resistance lines with fractal analysis, but we don't have the time to explore this topic deeply here. Notice that in this case, the inward frequency correlated with the upper limit of the fair value gap, but that's not always the case. Another thing that will draw the attention of fractal flow students is the bearish fractal candle that breaks the dynamic frequency of the last upward price vector. The other thing that is quite clear here is the possibility of drawing an Andrews pitchfork in the expanded pivot formation, like you can see in this chart. This is just a standard pitchfork. Since you already saw how this market developed, you can probably see where this is going. Moving a few candles into the future, we can notice something very interesting. Price is respecting the upper boundary of the pitchfork since it touched it 2 times without violating it. You can also see pitchfork lines as sloping support and resistance lines. Notice how the first touch would give you an extremely precise trade entry. Also observe how price is reacting to the inward frequency line. Notice also that the second touch of the inward frequency line is a bearish fractal candle. In this case, this fractal candle also has the shooting star formation if you want to look at this from the perspective of Japanese candlestick patterns. A shooting star is always a fractal candle, but not all fractal candles are shooting stars. Fractal candles can assume many different forms. We can even employ a smaller pitchfork to add an extra layer of confirmation for this short trade idea, as you can see here. The upper shadow of the current candle pokes 3 important levels: the horizontal inward frequency line, the upper downsloping line of the large pitchfork, and the upper upsloping line of the small pitchfork. Notice how the inward frequency line shows 4 possible entries, and the pitchfork shows 2. Let's assume that the trader enters this short position at the inward frequency, which would be the easiest alternative. Here's one advantage of using sloping lines like the pitchfork. The longer you stay in the trade, the greater the target. so the more you get paid. In other words, the longer you allocate your capital in a trade, the greater the reward you get, which makes perfect sense from the perspective of cost of capital. If price goes straight down from this point, the risk-reward ratio is already 1 to 3, but we can update the target lower as price moves toward the lower line of the large pitchfork. Moving this chart into the future, we can see that price touched the upper line of the large fork one more time before moving down, and if we updated the target along with the lower line of the pitchfork, the trade will close with a 1 to 3.46 risk-reward ratio. You can always observe what price does at the lines of important pitchforks. In this case, it did not react to it, so it tends to move lower to the double line or warning line of this pitchfork, which you can see here. In this final chart, you can see how price indeed respects the lower line of the double pitchfork, and that's all based on the geometry found in the expanded pivot formation at the top of this chart. There are other ways of seeing this trade using different tools of technical analysis, but of course I want to draw your attention to the methods I find to be the most reliable. In conclusion, you can see ICT entry models using other traditional perspectives of technical analysis, and this is just one example of how that would manifest in real price charts. Beyond that, the idea of integrating multiple technical analysis approaches, which is what I teach, allows you to see more high-quality trades like this. You don't want to trade just with high quality, you want to trade with high quality and with high frequency as well. By the way, the idea of integration is not only taught by me, it's a recurring theme in all respected technical analysis certification programs in the world. It's the most important principle not only in technical analysis, but in other types of trading approaches too. Perhaps an even more important conclusion is that you don't need to choose between ICT or other approaches. You can form your own approach by thinking what's best about each one, and trade the intersection between them. That's the best value you can extract from technical analysis. If you have interest in learning techniques related to what you saw in this video from the point of view of integration, I suggest you get my Price Action Trading Volume 1 to begin. I will leave a link in the video description and in the fixed comment. In this course, you'll be able to find over 40 different price action techniques that will greatly enhance your capacity to spot high-quality trade opportunities. If you have doubts about this methodology or any other matter related to trading, you can contact me at support@fractalflowpro.com. You can find more information about my other courses and ebooks on my website fractalflowpro.com. This is it for this video. If you like what I do and wish to support the channel, please click the like button, subscribe to the channel, activate the notifications button, leave your comment below, and share this video with your trading community. Thank you very much for watching, and I hope to see you in the next videos. Take care.